Imagine, you earn $1 in Germany.
Okay.
You run this successful subsidiary over there, you sell a product, and, a single US dollar equivalent just drops into your corporate bank account in Berlin.
Right. A very common scenario.
Yeah. And to anyone else in the world, the story of that dollar is basically over. I mean, you earned it, you hold it.
It's yours.
Exactly. But if you are a US shareholder of that foreign corporation, the story hasn't even started.
Not even close.
Because by the time that dollar legally hits your U.S. bank account as a distribution, like an actual wire transfer, the IRS requires this forensic multi-year biography of its entire existence.
Yeah, they really do.
They want to know where it slept, what currencies it touched, what foreign taxes it paid, and exactly what flavor of U.S. tax law it triggered while it was just, sitting overseas.
I mean, it is less of a tax filing and more of an anatomy of global commerce at that point.
Wow, yeah.
The IRS has constructed this system where that single dollar is tracked through a sequence of interlocking ledgers. And the whole point is to ensure that by the time you actually spend it in the United States, it has been subjected to the precise amount of taxation, no more, no less, that's been dictated by, decades of legislative maneuvering.
Which is wild. So, welcome to this deep dive.
Glad to be here.
If you are listening to this, you are likely already navigating the murky, often contradictory waters of U.S. international tax law.
Oh, definitely.
And you know that compliance isn't just about filling out boxes on a PDF. It is about proving the mathematical reality of your global operations.
Yeah, proving the math is the hard part.
Right. So today we are opening up the master ledger of international tax compliance. We are tackling part 2 of the Form 54721 schedules.
Heavy hitters.
Exactly.
Yeah.
Specifically, we're going to tear apart schedules J, P, Q, and R to really understand how offshore earnings are categorized, claimed, analyzed for credits, and finally distributed back to you.
And, the philosophy behind these 4 schedules is really driven by a dual mandate from the Treasury.
A dual mandate?
Yeah. On one hand, they are the mechanism by which you claim your legal right to avoid double taxation.
Which is what taxpayers want.
Right. But on the other hand, they are the net the IRS uses to ensure absolutely nothing slips through the cracks of deferral.
Ah, I see.
So the sheer complexity we are going to unpack today is just the unavoidable byproduct of demanding absolute precision in an inherently messy global economy.
So let's start at the very beginning of the dollar's biography, right? To understand how a distribution is taxed when it eventually hits your account, we first have to understand the molecular makeup of the money sitting inside the controlled foreign corporation to begin with.
Right, the CFC.
Yeah, the CFC, the corporation's master ledger. That is Schedule J. And a crucial detail right out of the gate is that Schedule J does not care about U.S. dollar.
Correct. Not at all.
Which is counterintuitive for a U.S. tax form, right?
It is, yeah. Schedule J tracks a CFC's accumulated earnings and profits, or ENP, exclusively in the foreign corporation's functional currency. And this computation is governed by Section 964, subsection A, and Section 986, subsection B.
Got it.
And we should really clarify that ENP is not just retained earnings on a GAAP financial statement.
Right, it's not just standard accounting.
No, ENP is a highly specific tax concept. It is a measure of a corporation's true economic ability to pay dividends, but it's completely adjusted for U.S. tax principles.
Meaning you could have a situation where your local foreign accounting books say you have no profits, but U.S. EMP rules say you actually have millions available to distribute or vice versa.
Exactly. It happens all the time.
Wow. So Schedule J forces you to take that total economic capacity and sort it into distinct, highly regulated columns.
Yeah.
These are the buckets of EMP governed by Section 959, subsection C.
And sorting these buckets, it requires an understanding of U.S. legislative history. Really.
Wait, history? Why?
Because the columns are essentially geological strata of tax reform.
Oh, that's an interesting way to put it.
Let's look at the untaxed earnings first. You have column A, which holds post-2017 EMP that has not been previously taxed.
Yeah, right.
This is your post-2017 Section 959, subsection C, paragraph 3 balance.
Right, the TCJA era.
Exactly. Then you step back in time to column B, holding post-1986 undistributed earnings.
Okay.
And finally, column C, for pre-1987 ENP.
So the IRS is literally forcing taxpayers to maintain ledgers based on the exact era the money was earned.
Yes.
Because 1987 marks the aftermath of the Tax Reform Act of 1986, which, dramatically overhauled foreign tax credit pooling.
Right.
And 2018 is the dawn of the Tax Cuts and Jobs Act. the TCJA, which brought us GILTI and the transition tax.
Yep, completely changed the landscape.
So the law at the time the dollar was earned dictates how it must be treated today, even if that dollar has been sitting in a German bank account for 30 years.
That historical anchoring is critical. Oh yeah, if you pull a dollar from column C, that pre-1987 bucket, it carries entirely different foreign tax credit implications than a dollar pulled from column A.
Oh, wow.
It does not qualify for the same pooling rules.
That sounds like a massive headache to track. And then sitting right next to those historical buckets, we have column D.
Ah, yes, column D.
Which tracks hovering deficits and suspended taxes. This seems to be the holding pen for corporate bad news, right?
It really is. It is the quarantine zone.
Quarantine zone.
Yeah. If a foreign corporation undergoes a reorganization or acquires another entity that brings a massive E&P deficit with it.
Like they bought a failing company.
Exactly. The U.S. tax code doesn't generally let you use that acquired deficit to immediately wipe out your existing profitable E&P.
Right, because that would be too easy of a loophole.
Way too easy. Instead, under Section 381, that deficit hovers.
It hovers.
It is tracked in column D and can only be used to offset future earnings generated after the transaction. It is essentially suspended animation for losses.
Okay, so we have the untaxed buckets in the quarantine zone. But the true forensic nightmare of Schedule J, the reason tax directors lose sleep over this form, is column E.
Yes, column E.
This is where we track previously taxed E&P, or PTEP.
The famous PTEP.
Right. This is money that the U.S. government has already assessed a tax on, even though it hasn't been distributed yet.
Correct.
But Schedule J doesn't just let you put all your previously taxed money into one big pile. It forces you to sort that PTEP into 10 distinct subgroups.
10 different statutory flavors of already taxed income.
10. That's insane.
It is. To name a few of the heavy hitters, you have amounts from the Section 965 transition tax.
Okay.
You have Section 951 Cap A inclusions, better known as GILTI.
Right.
You have Section 245 Cap A, subsection D hybrid dividends.
Wow. Okay.
And you have your traditional subpart F inclusions under Section 951, subsection A, paragraph 1, subparagraph A.
That's a mouthful.
And there are 6 more highly specific subcategories beyond those.
I have to play devil's advocate here because from a business perspective, this borders on the absurd.
I don't disagree.
If this is previously taxed earnings and profits, meaning the U.S. government has already taken its cut, why on earth do they care how it is categorized?
Right.
I mean, isn't taxed just taxed? If I already paid the toll to get on the highway, why does the toll operator care if I paid with quarters or a credit card?
Because the toll operator in this scenario is managing a deeply fragmented highway system.
Okay, I like that analogy.
It helps to think of these 10 PTEP buckets not as a bank vault where all money is treated equally, but as an industrial water filtration system.
Okay, water filtration. Walk me through that.
The income is the water. The fact that the water is in the PTEP system means it has been cleaned, meaning it's been taxed.
Right.
But the IRS needs to know exactly which chemical process cleaned it,
Why?
because that determines which pipes it can legally flow through next without blowing out the plumbing of the foreign tax credit system.
So treating all previously taxed money the same would actually break the math when you try to bring it home or claim a credit.
Completely shatter it.
Give me an example.
Let's look at this Section 965 transition tax from the 2017 tax reform.
Okay.
Congress forced companies to pay a one-time tax on decades of accumulated offshore earnings. But they offered a lower effective tax rate on that money.
Right, the repatriation holiday, basically.
Exactly. Because the U.S. tax rate was artificially lowered on that specific income, the law, specifically Section 965, subsection G, dictates that you can only claim a foreign tax credit for a portion of the foreign taxes you paid on it.
Ah, I see.
Yeah.
So if you mix that transition tax money into a general PTIP-P bucket alongside your traditional subpart F money, which allows for a full foreign tax credit, you would dilute the pool.
You would.
You might end up claiming a 100% credit on foreign taxes when the law only entitled you to a 40% credit.
Exactly. Mixing the buckets would lead to massive, illegal arbitrage of foreign tax credits.
Oh.
Congress created 10 different regimes of taxation, each with its own specific limitations, deductions, and currency translation rules.
So the IRS was forced to build a master ledger with 10 different columns to ensure those legislative boundaries are respected in perpetuity.
They had no other choice.
So the ledger is set. The corporation knows exactly what buckets its functional currency is sitting in,
Right.
but this money isn't static. Multinational corporations are constantly moving capital around, making investments, shifting assets.
Every day.
And this forces us to look at the internal mechanics of Schedule J. How does money shift between these buckets before a single dime is ever actually distributed as a dividend?
Yes, the mechanics.
This all comes down to the ordering rules and the reclassifications, right?
It does. And the most critical mechanical movement on Schedule J happens on line 10.
Line 10, okay.
The form defines this as amounts reclassified to Section 959, subsection C, paragraph 1, EMP, from Section 959, subsection C, paragraph 2, EMP.
Okay, let me synthesize what that actually means, because those paragraph citations mask a very aggressive IRS anti-deferral mechanic.
Big deal.
The tax code organizes EMP into a three-tier waterfall. At the bottom of the waterfall, you have paragraph 3, which is the untaxed offshore earnings.
Right.
In the middle, you have paragraph 2, which is your previously taxed income, your GILTI and your subpart F.
Right.
But at the very top of the waterfall, you have paragraph 1, which is previously taxed earnings that have been explicitly invested in U.S. property under Section 956.
Yes, the U.S. property investment is the apex of the waterfall.
Why is that?
And the reason for this goes back to the core philosophy of deferral. If a CFC has untaxed earnings sitting in Germany, and instead of paying a dividend, it simply loans that money to its U.S. parent company.
Or buys a warehouse in Ohio, like we always see in the examples.
Exactly, buys a warehouse in Ohio. The U.S. parent has achieved the economic benefit of the cash without officially declaring a dividend.
Right.
So Section 956 steps in and says, we see what you are doing. You brought the economic value home, so we are going to tax it as if you distributed it.
But the friction happens when a CFC decides to make that U.S. property investment using money that was already taxed.
Yes.
Like if the German subsidiary uses its GILTI earnings, which the U.S. shareholder already paid tax on, to buy that warehouse in Ohio, the IRS can't tax them again. That would be double taxation.
Exactly, they can't.
But they still demand that the ledger reflect this specific economic movement.
Which is exactly what line 10 of Schedule J executes. If the CFC uses previously taxed paragraph 2 money to invest in U.S. property, you must subtract that amount from the paragraph 2 bucket and add it to the paragraph 1 bucket.
You are reclassifying.
You're reclassifying it up the waterfall.
Let's run some numbers to make this concrete for you listening. Say our German CFC has an accumulated balance of $36 in its Section 959, subsection C, paragraph 2 PTEP account.
Okay, $36.
That is $36 of previously taxed subpart F income. During the current tax year, the CFC makes a $40 loan to its U.S. parent company.
Right.
That is a $40 investment in U.S. property. Because there is $36 of previously taxed money available, the mechanical rules force the CFC to reclassify that $36 from paragraph 2 to paragraph 1 on Schedule J.
That's right.
And what happens to the remaining $4 of that loan?
Well, the CFC exhausted its previously taxed bucket, right?
Right.
So that remaining $4 must pull from the untaxed paragraph 3 bucket at the bottom of the waterfall.
Ouch.
Yeah. That $4 pull triggers a brand new taxable Section 956 inclusion for the U.S. shareholder.
This reclassification feels incredibly punitive at first glance, forcing tax directors to shuffle numbers across a spreadsheet just because an intercompany loan was made.
It does feel like busy work.
But it is actually a defensive shield for the taxpayer, isn't it?
It absolutely is.
Because by forcing the U.S. property investment to absorb the already taxed money first, the IRS is preventing you from accidentally pulling from the untaxed bucket and getting hit with a massive, unexpected tax bill.
Exactly. The strict first-in, first-out logic, based on tax status, protects the taxpayer from double taxation.
It is a rigid, unforgiving algorithm.
It is a rigid, unforgiving algorithm, but the algorithm is fair, provided you maintain the data integrity of Schedule J year after year.
So the corporation's master ledger is balanced, the water is in the right pipes.
Yeah.
But here is the fatal flaw in stopping at the corporate level. What if multiple U.S. shareholders own this single CFC?
Oh, this is where it gets fun.
Right. How does a 20% minority shareholder actually claim their specific slice of those previously taxed buckets without stepping on the data of the 80% majority shareholder?
It's a huge issue.
This operational reality bridges us directly to Schedule P, the shareholder's personal receipt.
So Schedule J is the entity level view. It tells you what the corporation holds in total.
Okay.
Schedule P is the shareholder level view. It is filed by the specific U.S. shareholder to report their distinct pro rata share of the PTEP tracked on Schedule J.
Got it.
And while Part 1 of Schedule P mirrors Schedule J by tracking everything in the CFC's functional currency, Part 2 introduces a variable that completely changes the math, the US dollar basis.
This is where we shift from pure tax law into global macroeconomics.
We do.
Why do we suddenly have to calculate a US dollar basis when the entire ledger has been strictly maintained in foreign currency up to this point?
Because, simply put, you pay your US taxes in US dollars.
Fair enough.
The US dollar basis on Schedule P is generally equal to the exact dollar amount you previously included in your gross income on your US tax return in the year the tax was triggered.
Let's look at the timeline.
Sure. Imagine in 2020, your German CFC generates 100 euros of Subpart F income.
Okay.
Under the rules, you are taxed on that immediately. On the day you included it in your US income, the exchange rate dictates that 100 euros equaled 110 US dollars.
So I pay tax on $110.
Exactly. You pay US tax on $110. Therefore, your Part 2 US dollar basis in that specific PT bucket is locked in at $110.
Okay, the basis is locked, the tax is paid, the money sits in Germany.
Fast forward to 2025. The CFC finally decides to distribute that exact same 100 euros to you in cash.
5 years later.
5 years later.
Yeah.
But the macroeconomic environment has shifted. The euro has weakened against the dollar.
Oh boy.
Now, when that 100 euros hits your US bank account, it converts to only 90 US dollars.
Wait, so I paid tax on $110 of economic value, but I only received $90 of actual cash?
Precisely. And the tax code does not ignore that loss of purchasing power.
It doesn't.
No. You must recognize the $20 currency fluctuation as an ordinary foreign currency loss on your U.S. tax return under Section 986, subsection C.
Wow.
Schedule P is the critical mechanism that makes this calculation possible. It is the receipt that proves what the money was worth in dollars on the day the IRS originally taxed it, allowing you to calculate the delta on the day the money is actually distributed.
This is a staggering realization for anyone outside the tax world.
It blows people's minds.
Just by holding a compliant, perfectly legal foreign asset over a period of years, the U.S. tax code forces you to isolate and account for foreign exchange trading.
Pretty much.
You are capturing the phantom gains and losses of the global currency markets layered on top of your standard corporate profits.
It adds an immense layer of volatility to long-term tax planning.
I can imagine.
Because if the currency moves the other way and the euro strengthens, you could be hit with a massive unexpected foreign currency gain upon distribution.
Triggering a secondary tax event on money you thought was completely protected as PTAC.
Exactly. It's never simple.
But Schedule P isn't just about currency translation. It also solves one of the most practical human problems in corporate joint ventures.
Oh, this is a great topic.
What happens when business partners do not want to share their proprietary tax data with each other?
The Corp A and Corp B blind spot. This is a classic compliance headache that exposes how interconnected the U.S. tax code has become.
Let's lay out the scenario for you listening. Corporation A and Corporation B decide to form a joint venture. They both own a percentage of a single CFC.
Okay.
According to the strict rules of tax accounting, the CFC's Schedule J, the master ledger, should show exactly $70 of GILTI PTAP in total for the year based on the aggregate operations of the joint venture.
Right, $70 total.
But when it comes time to file, Corp A only calculates a $20 GILTI inclusion for itself, and Corp B only calculates a $50 GILTI inclusion. They know their own numbers, but they do not know the aggregate total.
And to understand why they don't know the total, you have to understand how GILTI is calculated.
Go ahead.
It is not computed solely at the CFC level. The GILTI calculation depends on attributes specific to the U.S. shareholder.
Okay.
To calculate their inclusion, a shareholder needs their pro rata share of the CFC's tested income, but they also get to reduce that inclusion based on their own qualified business asset investment, or QBAI.
Which is essentially their tangible, depreciable assets, factories, equipment, real estate.
Exactly. Corp A has no idea what Corp B's global QBAI profile looks like.
Right.
Corp B might have billions of dollars in tangible assets scattered across other entities that offset their GILTI burden. Corp B is absolutely not going to hand over its highly sensitive proprietary global asset data to Corp A just so Corp A can fill out a tax form for one joint venture.
That makes total sense. They are business partners in this one entity, not merged corporations. They legally protect their data.
Yes.
So we have a stalemate. Corp A fills out the form 5471 and says, well, the master ledger should just be $20 because that's all the math I can legally prove.
Right.
And Corp B files their own 5471 saying the master ledger is $50. If they file those forms, neither of them matches the true mathematical reality of the CFC.
No, they don't.
And historically, filing an incomplete or inaccurate Form 5471 carries draconian penalties, thousands of dollars per form, and it can keep your entire tax return open to audit indefinitely. How does a tax director survive this without breaching corporate confidentiality?
They survive because the IRS recognized this exact friction point and introduced an incredibly pragmatic workaround.
Really? The IRS being pragmatic?
I know, shocker. On Schedule J, there's a specific box you can check that indicates, essentially, I do not have access to all U.S. shareholder information.
The legal I surrender box. I love it.
Pretty much.
It is the IRS admitting that business reality trumps theoretical tax perfection.
It is a rare concession. If you check that box, Corp A files its Schedule P showing its $20 receipt. Corp B files its Schedule P showing its $50 receipt.
Okay.
The IRS receives both returns and their internal systems aggregate the data. Then the following tax year, once the dust is settled and the total tax profile of the CFC can be historically reconciled without sharing forward-looking proprietary data, the shareholders update Schedule J to reflect the combined $70.
Ah, so they fix it retroactively.
Exactly. They show the other shareholders PTEP as an adjustment on line 1B of the form.
It perfectly illustrates why Schedule P is the linchpin of the system. If Schedule J is incomplete because of these corporate blind spots, Schedule P is the only true anchor the IRS has.
It is.
It ties the specific, quantifiable tax burden to the individual taxpayer when the entity-level data is opaque.
It also reinforces the idea that Form 5471 is a living document.
Yeah.
You are constantly reconciling the present against the gaps in last year's data.
So we have the earnings categorized on Schedule J, and we have the personal receipt locked in on Schedule P, but we have ignored the massive elephant in the room.
The foreign taxes.
Exactly. This foreign corporation operates in a foreign jurisdiction. It pays taxes to the German government or the Italian government. The entire purpose of this labyrinth is to avoid double taxation globally.
Right.
So how do you claim credit for the taxes the CFC already paid? This brings us to the most analytically demanding part of the entire life cycle. Schedule Q, the mechanism for slicing the income for foreign tax credits.
If Schedule J is the master ledger, Schedule Q is the forensic autopsy.
I love that comparison.
Its statutory purpose is to report the CFC's income, deductions, taxes, and assets broken down by CFC income groups.
And the high-level grouping seems simple enough. You divide the CFC's economic world into three main buckets.
Right.
You have your subpart F income groups, which would capture things like foreign-based company sales income. You have the tested income group, which maps to your GILTI calculations. And you have the residual income group, which catches everything that doesn't fit into the first two. It sounds like standard categorization.
It sounds simple until you apply the mandate of Treasury Regulations, Section 1.904-4, subsection C, paragraph 4.
Oh boy, here we go.
This regulation dictates that you cannot just lump all your subpart F income together for the entire CFC. You must apply these grouping rules and report gross income, definitely related expenses, interest expense, and creditable foreign taxes separately for each tested unit.
Let's define tested unit because it is not just a subsidiary. The complexity goes far deeper than the legal entity structure.
A tested unit can be a controlled foreign corporation itself, but it can also be an interest in a pass-through entity, a branch operation, or a disregarded entity.
Okay, give me an example.
If your German CFC operates a small branch office in France and wholly owns a disregarded entity in Italy, you do not have one CFC to analyze. You have three distinct tested units.
Wow.
You are forced to perform this granular income and expense allocation for Germany, France, and Italy entirely separately on Schedule Q.
This is like doing an autopsy on a ghost.
Basically.
The IRS is demanding a forensic breakdown of the economic reality. It's not enough to say the company made $1 million and paid $100,000 in foreign taxes.
Not even close.
You have to trace exactly which branch generated the revenue, which specific localized expenses offset that revenue, and exactly what local municipal tax was assessed on that specific margin, all before you can claim a single dollar of U.S. tax credit.
The reason for this excruciating granularity is to prevent foreign tax credit arbitrage, specifically cross-crediting.
Ah, cross-crediting.
Yes. The U.S. Treasury wants to ensure that a high tax paid by the Italian disregarded entity isn't being inappropriately blended to shield low-taxed income generated by the German CFC from U.S. tax. They fence the credits in.
But tracing taxes to income gets incredibly complicated when you deal with transactions that the U.S. tax code refuses to acknowledge.
Oh, the disregarded payments.
Let's look at the scenario of a disregarded payment.
This is where Schedule Q compliance becomes an absolute nightmare for tax departments.
Okay, let's walk through it.
Let's use our same structure. The Italian disregarded entity makes a massive royalty payment up to its parent, the German CFC.
Okay.
For U.S. tax purposes, because the Italian entity is disregarded as separate from the German CFC, that payment is a phantom. It is treated as moving money from your left pocket to your right pocket.
Right. It generates no U.S. taxable income.
None.
But the Italian government does not care about U.S. entity classification rules.
They absolutely do not.
The Italian government sees a real payment crossing its borders, and they impose a 10% withholding tax on it.
Exactly. So now the U.S. shareholder has a very real receipt for a tax paid to Italy. But the income that generated the tax technically does not exist in the eyes of the IRS.
Because it was just left pocket to right pocket.
Right. So how do you assign that tax to an income group on Schedule Q so you can claim a credit?
You have to look to Treasury Regulation Section 1.861-20, and the answer depends on the forensic nature of the payment.
The regulations require you to categorize the phantom payment. Is it a remittance, meaning the Italian entity is repatriating earnings back up to Germany?
Okay.
Or is it a contribution, meaning Germany is pushing capital down into Italy?
And why does that matter?
If the payment is a remittance, the regulations dictate that the withholding tax must be assigned to the statutory groupings based on the accumulated earnings, or, alternatively, the asset apportionment percentages of the payer taxable unit, the Italian branch.
I'm gonna make sure I'm following.
Yeah.
So because the income doesn't exist, you have to reverse engineer the tax back to the underlying physical assets of the Italian branch.
Yes, you do.
You have to analyze the tax basis of the Italian assets, categorize those assets into Subpart F or GIL-TI buckets, and then allocate the withholding tax based on those asset ratios just to find a legally permissible place to park the credit on Schedule Q.
And if it was a contribution instead of a remittance, the rules flip entirely.
Of course they do.
You have to allocate the tax based on the income generated by the specific property being contributed. The administrative burden this places on a multinational company is staggering.
I can't even imagine.
If you have 20 of these tested units making disregarded payments to each other, you are employing an army of forensic accountants to trace phantom payments and apportion interest expense based on the physical location of assets, all to claim a credit for a tax you already legally paid to a sovereign nation.
It is a phenomenal hidden cost of doing business globally. The tax preparation costs to generate Schedule Q for a mid-sized multinational can easily run into the hundreds of thousands of dollars.
Easily.
But from the IRS's perspective, this is the unyielding wall that protects the U.S. tax base. It is also the reason we see companies making high-tax elections under GIL-TI or taking consolidated positions under Section 18992. They are actively looking for statutory relief valves to simplify this grouping nightmare.
But assuming you survive Schedule Q, assuming you have perfectly allocated your expenses and assigned your foreign taxes to the correct tested units, you finally reach the moment that matters to the CFO.
The payout.
The payout.
We have categorized the ledger on J, assigned the receipt on P, and sliced the tax credits on Q. Now, the money actually moves out of the foreign corporation and into the hands of the U.S. shareholder. This triggers the final phase of our deep dive, Schedule R distributions from a foreign corporation.
Schedule R is where the theoretical architecture of tax code crashes into the actual movement of cash.
Right.
Its purpose is to report basic information pertaining to actual distributions made by the foreign corporation during the tax year.
It seems like it should be the simplest form. You wired $1 million, you report $1 million.
If only.
But Schedule R forces you to describe the exact nature of the distribution. Was it cash? Was it property? Was it a bizarre reorganization treated as a dividend? And most importantly, you have to track the exact code sections that determine the taxability of every single penny in that wire transfer.
This is where we see the ordering rules from Schedule J perfectly executed in reality.
Ah, the waterfall again?
Exactly. When an actual distribution occurs, the law strictly dictates that it must be pulled from the previously taxed PTEP buckets first, if any exist.
Right, paragraph 1, then paragraph 2.
Right. Only after every single dollar of PTEP is exhausted does the distribution pull from the Section 959, subsection C, paragraph 3, untaxed balance.
And this creates the mathematical golden thread of Form 5471.
Yes.
There is an absolute equation that ties this entire life cycle together, and the IRS computers look for it instantly.
They absolutely do.
The total amount entered in Schedule R, column D, which is your actual distribution, must exactly equal the amount on Schedule J, line 9, column F, which is the distribution subtraction on the corporate master ledger.
Right.
Furthermore, that number must also equal Part 1, line 8, of Schedule P, which is the distribution subtraction on the personal shareholder receipt.
It is a closed-loop system.
I love that, a closed-loop system.
Yeah. If you executed your currency translations, your bucket allocations, and your ordering rules correctly across J, B, and Q, then Schedule R flows perfectly. The numbers lock together like a vault door.
And if they don't?
But if the math breaks across those three schedules, you have a structural error in your compliance, and the IRS will find it.
Let's walk through a hyper-specific example of how a single wire transfer fractures into multiple tax consequences on Schedule R.
Okay, let's do it.
A U.S. corporate shareholder receives a $100 cash dividend from its CFC. On Schedule R, the tax director cannot just enter $100 on a single line. Following the strict ordering rules, that $100 might have to be reported across 4 entirely separate rows.
Let's follow the waterfall. The CFC looks at Schedule J and sees it has $30 of accumulated PTEP.
Okay, $30 of PTEP.
So the first $30 of that wire transfer is carved out. That goes on the first row of Schedule R, coded as a non-taxable distribution of PTEP under Section 959, subsection A.
Okay, that makes sense. It comes home tax-free because the toll was already paid.
Exactly.
The remaining $70 must now pull from the untaxed buckets. Let's say the next $15 of the CFC's EMP qualifies for the special participation exemption created by the TCJA.
Right.
That $15 goes on a second row, coded as a taxable dividend eligible for the Section 245 Cap A dividends received deduction. Effectively, this also comes home without additional U.S. tax, but under a completely different statutory mechanism.
Now we have $55 left to account for. Let's say the CFC only has $25 of EMP remaining, and it is old, pre-1987 earnings that do not qualify for any special deductions.
The old stuff.
The old stuff. That $25 goes on a third row, coded as a standard taxable dividend under Section 301, subsection C, paragraph 1.
So that gets taxed.
Yes. This portion will be fully subject to U.S. corporate tax rates, potentially offset by whatever credits survived the Schedule Q forensic analysis.
Okay, wait, let me check the math. We had $30 of PTEP, $15 of DRD, and $25 of standard taxable dividend. That's $70.
Correct.
We have accounted for $70 of EMP, but the actual cash wire was $100.
Wow.
The CFC is completely run out of earnings and profits. What happens to the last $30 of the cash?
Once EMP is exhausted, the distribution begins to erode the U.S. shareholders' actual basis in the stock of the CFC itself.
Oh, wow.
Let's say the shareholder originally invested $50 to capitalize the CFC. The next $30 of the wire transfer goes on a fourth row of Schedule R, coded as a non-taxable distribution applied against basis under Section 301, subsection C, paragraph 2.
It is treated as a return of capital.
Exactly.
So one single $100 wire transfer, 4 completely distinct tax consequences, 4 different statutory citations, requiring a seamless flow of data from historical ledgers that track back decades.
Yep.
Schedule R isn't just a reporting form, it is the ultimate proof of work. It is the final exam proving you understand the specific biography of every single dollar sitting in that foreign corporation.
And we haven't even touched on the complexity of non-cash distributions.
Oh my goodness, right.
What if the CFC doesn't distribute cash, but instead engages in a sophisticated cash pooling arrangement with its sister subsidiaries that the IRS deems to be a constructive dividend?
It's treated like a distribution.
Or what if the CFC undergoes a Section 368 reorganization and the boot, the cash received in the merger, is treated as a distribution?
More complexity.
Schedule R must capture all of these phantom economic movements and subject them to the exact same rigorous ordering rules.
It requires a level of diligence that goes far beyond traditional accounting. You aren't just tracking revenue and expenses, you are tracking the specific legislative intent applied to every dollar of margin across its entire global lifespan.
It's exhausting, but necessary.
Let's take a breath and recap the journey we just mapped out. We started with a dollar earned in Germany.
The famous German dollar.
Exactly. We categorized it in the Schedule J master ledger, figuring out if it was GILTI, Subpart F, or untaxed, and forced it through the waterfall of U.S. property investments.
Yep.
We then assigned that specific dollar to a minority U.S. shareholder in the Schedule P receipt, locking in its U.S. dollar value to track foreign currency fluctuation.
The receipt, exactly.
We paused the distribution to analyze that dollar for foreign tax credits in the Schedule Q breakdown, isolating it by tested unit and reverse engineering phantom, withholding taxes back to physical assets.
The autopsy.
And finally, we legally distributed the dollar via Schedule R, ensuring the math tied perfectly back to the very first ledger.
It is a monumental architecture of compliance. And understanding the mechanics of how these forms talk to each other is the only way to strategically navigate international operations. If you view them in isolation, you will inevitably miscalculate your tax burden.
As we wrap up this deep dive into the underlying logic of U.S. international tax schedules, I want to leave you, the listener, with a final, slightly mind-bending reality to ponder.
Okay, hit me with it.
We spent a lot of time discussing Part 2 of Schedule P, the U.S. dollar basis. We talked about how minor currency fluctuations between the euro and the dollar create foreign currency gains or losses.
Right.
But consider the extreme edges of global macroeconomics. What happens when a foreign corporation operates in a jurisdiction experiencing hyperinflation, say Argentina or Turkey?
Oh, the math breaks in spectacular fashion.
Yeah, exactly. A massive, record-breaking operational profit in the functional currency of that country, billions of local currency units, could translate to absolute pennies in U.S. dollars by the time it is actually distributed years later.
Because of the locked basis?
Yes. Because the U.S. tax code forces you to lock in the dollar basis at the time of inclusion, you could pay U.S. tax on what appears to be a highly profitable operation, only to recognize massive, crushing foreign currency losses years later when the distribution finally occurs.
It's brutal.
You aren't just managing tax law anymore. You are being forced to gamble on the stability of sovereign fiat. The changing value of a currency literally alters the mathematical reality of your tax burden.
It does.
How do you plan for a corporate tax bill when the measuring stick itself is constantly shrinking?
It highlights the ultimate friction of Form 5471. It is attempting to apply rigid, absolute mathematical certainty to a global economy that is constantly shifting under our feet.
That is something to mull over the next time you look at a balance sheet. The diagnostic, muddy waters of international compliance aren't just caused by complex tax codes written in Washington. They are caused by the chaotic reality of the world.
Very true.
Thank you so much for joining us on this deep dive into the Form 5471 ecosystem. Remember to keep questioning the mechanics behind the forms, keep tracing the logic of the ledgers, and we will catch you on the next one.